Well, hi, Columbus folks. Good to see you again. Third panel of the day, fourth panel if you're counting because we split one and two. But our host, Greg Schenk, is having technical issues. I've seen him pop into the room and pop back out, so we'll see what happens. I'll try to hold the ship together, but we've got some really senior people here that really don't need to be moderated. So to that extent, go in the chat room and ask questions. That'll help kind of dictate this conversation and the direction we're going. Let's start with intros, though. And I know everybody might be in a different order on your screen, but Alex is to my right. So Alex, my right, what I'm looking at, so my left. So tell us what you're up to, Alex, who you are, who you work for, and what's going on.
Good morning. My name is Alex Vulich. I'm the Vice President of Development at the Pizzuti Companies here in Columbus, Ohio. I'm focused on industrial development, primarily logistics and distribution centers. I've been with Pizzuti for not too long, less than a year now, but I spent 15 years prior to that with Prologis, both here in the Midwest, Cincinnati, Northern Kentucky, Columbus, as well as out in the Pacific Northwest, Portland, Oregon, and Seattle, Washington. Happy to be here today. Again, the industrial sector, particularly in Central Ohio, keeps moving. There's a lot of appetite, both from the user standpoint as well as the capital standpoint, and I'm sure we'll touch on that as we continue.
Yeah, for sure. Sorry, I'm in Minneapolis right now doing two events. That's kind of been a juggling act. Kevin, to you, tell us a little bit about yourself and what you're up to.
Good afternoon, everyone. My name is Kevin Zepernick. I'm the Principal and Chief Executive Officer for Thrive Companies, formerly known as Wagenbrenner Development. I joined Mark, who is still our Managing Principal here, about 2.5 years ago, and we are focused primarily on the Columbus market, really heavily geared towards mixed-use development on former, industrial sites. We do a lot of brownfield work, a lot of work with the EPA, and we've got a lot of exciting projects coming here in Columbus, and happy to be here today.
Kevin, excited to hear about that. Alec, we're going to have to go to you. Alec and Alex, this ought to be fun. Alec, tell us what you're up to and where you work.
Hey there, everyone. Alec Miller. I'm the Vice President of Real Estate over at Shift Capital Group. FYI, I'm having a little trouble hearing the moderator, so I'm just going to kind of try to go off of what I can hear from the other panelists. But we're focused mainly on multifamily development in Central Ohio and other similar markets throughout the Midwest. Certainly seen a little bit of a shift of perspective with everything going on, but at the end of the day, similar to what we're seeing on the industrial side of things, there's still a strong appetite both on the capital and the product side for Class A multifamily and Columbus and other Midwest markets, and it's there's a lot of activity, a lot of good interest and good activity even through COVID. So looking forward to digging further into some of the stuff that we're working on.
Excellent. Last but not least, my man Alfredo Gutierrez. How are you? What have you been up to? How's the industrial world?
Good morning. Well, in industrial world is looking a lot brighter than some of the other worlds, I think, right now. Good morning. I'm Alfredo Gutierrez, the founder and owner of Sparrowhawk. We are exclusively a merchant industrial investor. We've invested throughout the United States, focusing on different regions at different times in my 25, 30-year career. Currently, we are heavily weighted throughout the Midwest, and Columbus's market that we have owned product in the past, and currently have been looking to get back into. 2020 was the year that I wanted to pick a product in the Ohio's, and it's this virus has kind of put a little glitch on it, but looking forward to getting back out there and seeing a lot of the folks that are probably on the call today, and looking forward to visiting with the group that's on here. And I see Greg has joined us, so there he is.
Yes, good
Excellent.
morning. Sorry, we had some technical difficulties. It's good to be here with you all. And I'll give a brief intro of myself and we'll get right into it. This is my 34th year, believe it or not, in the business as an exclusive tenant rep broker. 24 actually this week with the Schenck Company, which I'm very proud of. 25 years traveling the country, speaking, teaching, and training. And the third time we've been so honored by Midwest Real Estate Magazine to be on the panel or host one of these sessions. So I'm really looking forward to getting some insight and discussing what's going on in the market. Thirdly, I invest all over the country myself. And because I speak and teach all over, I've traveled extensively this year. Not only before the COVID, I was away in California when it started. And then in May, I decided to take a road trip. So let me start off by saying in February of this year, I believe the economy was as strong as I've ever seen it in my 34 years in business and as long as I've been alive, which is now 60 years. In any market that I've gone to, no matter what the product type, I saw a lot of good things going on. In May, I took a 9-state road trip from Columbus to Florida. In every market I went into, I saw a lot of cranes. I saw a lot of activity. So even with the COVID, even with the riots and the protests, I think we've had an incredible run. So the question now is, what's next? How are the lending things going to be affected? How is tenancy going to be affected? And all these great people that we've got with us, how are their projects going to be affected positively and negatively? Did we get through all the introductions? I apologize again that I was late.
We did.
Okay, good. So let's get right into it. Where do we think is the biggest growth in Central Ohio? We can just go around the room. And Alfredo, I know you're doing more on a national scale than a local scale. So let's skip doing this one and go to Kevin. You know, where do you see, which areas of Columbus are you seeing for the biggest growth?
Great question. Honestly, I look at all of Central Ohio right now is still extremely, optimistic. In fact, I think we may come out of this as a market even stronger than maybe pre-COVID. A number of reasons. We've been following a lot of, national companies that focus on recruiting. If you looked at your LinkedIn's, you looked at some of your, virtual real estate companies like Redfin, Zillow, they're all continuously reporting right now that they're seeing this massive uptick in, I would call, tier 2 cities. I would never classify Columbus as a tier 2 city. I love this place. I don't think we're second to anybody. But if you look at the major markets, New York, Miami, the Washington, D.C. market, Chicago, L.A., I think we're going to see a lot of people wanting to move out of some of those areas that are becoming so, first and foremost, so expensive to live in. And secondly, I think people are looking for maybe a shift in their quality of life. Columbus, I think, is so well positioned as we were before pre-COVID. We may even be better coming out of this with the opportunity to pick up some continued population growth. We do have to see a massive, I think, uptick in our building permits as it relates to residential so we can support the job growth that may be coming in. We're still massively underserving our market, I think, in relation to the number of apartment units and for sale product that we're bringing online on an annual basis. Clearly, I think everybody's going to be on a little bit of not, I'd say, pause necessarily, but reassessment of what retail means and hospitality means as we move forward, not just in our city, but obviously nationwide. But like I said, I'm extremely bullish right now on the fact that Columbus is to your point, we've kept a lot of good momentum during the downturn, and I think we're going to come out the backside of this pretty stronger in just about every facet.
Wonderful. And I would agree with that wholeheartedly. Alec Miller, what are your thoughts?
Yeah, so to piggyback off of what Kevin said, I agree wholeheartedly as well. I think we're going to see, a lot of strong population growth, people coming from other, more saturated major markets, places like the New York, Chicago's of the world, who are attracted to Columbus, both, for the quality of life and cost of living. And I think due to that, Greg, kind of to go to your question, we're going to have to see a lot of revitalization of the CBD area, and we've already started to see quite a bit of that, and there's a number of exciting projects for the city in the pipeline. But these people are used to urban city living kind of live, work, play type environments. And as those people, come to the market, making sure that we build the infrastructure to support those people and keep them here is going to be incredibly important.
Awesome. All right, Alec Miller, what do you think?
I'll echo that. I mean, I think that Columbus is certainly trending dynamically in the right direction, and it's all about rooftops. It's all about people and attracting jobs and attracting people at the same time. From an industrial standpoint, of course, the big trend is it continues to be e-commerce. We've seen with COVID a shift in who is relying on e-commerce. Now it's not just your millennials, your Gen Zs. It's your mom who's ordering her groceries online, and that trend is accelerating. And frankly, on a national basis, we don't have the kind of facilities that are geared towards that. So it's an exciting time to have that capacity to grow. And I think here in Columbus, we've got a lot of that infrastructure in place to continue serving that population, not only here in Central Ohio, but regionally, throughout the Midwest, and then on to the East Coast. So, what'll be interesting to see, I think I've been focusing on population growth and a lot of the housing starts, and do we have the ability to service those distribution businesses coming in from a labor standpoint for the last 2-3 years, as we've seen unemployment, or as we saw unemployment track down, and then labor costs go up together with residential living costs. Obviously, with COVID, that's going to take a step back, I think, for at least some period of time, which will be interesting, and to see how that impacts on where development is going on an industrial basis.
Wonderful. Alfredo, do you have anything you want to add from a national perspective on this, since you're doing this all over the country?
Well, I would add a couple things. And it plays a little bit into the Ohio and Columbus market in particular. As Alex has already alluded to, e-commerce is exploding. It had ramped into the year strong, and I'm just speaking of industrial specifically right now, because that's all we do. It has exploded. It is probably going to double in the next 3 to 5 years. And so, for every $1 billion of retail, you get about 1.25 million square feet of industrial product. And going into the year, we were at just under 15% of retail sales were online. And that has popped up to 25%, but floated back down to probably closer to 20%, which is where it should be. But that will grow. What has not been talked about as much, I believe, is manufacturing. Our manufacturing during this pandemic has really been shut down. The exports aren't existing because as those markets in Europe and Asia shut down, the exports shut down. And those markets are just now opening up. And I think the export market is going to benefit a location like the Ohio's, because it has the manufacturing base, the employment base to attract some of those suppliers to manufacturing. So e-commerce is growing, but I think just as much manufacturing is, especially with the reshoring and nearshoring occurring, that's going to benefit a regional distribution area like Columbus, and all these cities similar to Columbus that are, million plus populations are getting fulfillment centers, because as Alex already alluded to, you're trying to get the product out to the rooftops. So there's a lot of good signs. It doesn't mean that industrial's insulated against the economic recession that is going on due to the shutdown, but it is in a better position than some of the other food groups that are out there right now.
Awesome. And anybody else have anything to add on that topic before we move on? Okay, let's get into the nuts and bolts, what everybody really wants to hear from your expertise. Tell us about the projects that you're doing now, how they're affected. Okay, let's just go around the room. And again, Kevin, you want to start us off?
Sure. Wagenbrenner Development's been around the Columbus market, for 50 years, starting with Mark and Eric Wagenbrenner's father and uncle. About 20 years ago, Mark and his brother and another founder, Brian Barrett, started heavily into brownfield development, and they've been doing an amazing job building up a tremendous land pipeline. We've got really 7 what I would consider major projects today that are anywhere from 20-acre sites that are urban to 60, 80. When we just purchased 2 years ago a 600-acre quarry just outside of Treby Road, just outside of Arlington. Multiple phases in each, mixed use in each, apartments for sale, office, retail. In many cases, we're focusing heavy on the next level of amenities that we think can be really attractive for people, wanting to relocate within our city and also pulling people to our city. We had a huge plan for Q1 and Q2 this year, and everything really just kind of went on pause. Our existing work, thankfully, was deemed essential, and we were able to stay very healthy as an organization and continue to push the next projects, basically to the starting blocks, just couldn't get going. And the big pause really wasn't from the market demand. We did not see really one blip on the radar in relation to at least our apartment side, which were Class A. Our for sale side has been insatiable. We have been taking more contracts than we can, that we can keep pace with in relation to building right now. Clearly, we took a little bit of pause on some of our office and retail. The biggest challenge came from, which I'm sure everybody out there experienced, was a little bit of hesitancy and pause from the banks. Capital is aplenty. There's more money out there right now today looking to park into a home than we could take, than we could ever take. The biggest challenge got back into our debt structures and having to make sure our banks felt comfortable with where the markets were going. We're starting to feel a lift. We're getting really close to securing our next round of debt structures, and we're expecting to break ground on a lot of these major projects here within the next 30 days and start to go vertical. Probably the biggest of all projects that I think will be something special for Columbus is our Quarry Trails project over off Tradeview. As I mentioned, it's a 600-acre quarry, former quarry site, former brownfield site. We've done 2 years of heavy remediation on the site. We've actually imported a little over 1 million cubic yards of dirt to the site to re-level and restructure, reshape. But probably the more special part of this is the private partnership we're taking on right now with Metro Parks. And for those of you that haven't had a chance, by some chance, to experience our amazing Metro Park system here, Tim Maloney and his team do a tremendous job for our region in creating really special outdoor green spaces. We partnered with them in the quarry, and they're taking over a couple hundred acres on our phase 1 that will be programmed heavily as an adventure park. So we are going to have in Central Ohio legitimate rock climbing walls and pump tracks, and we're cutting in between a upper pond and a lower pond and using a natural waterfall to feed kayak runs. And this will literally all sit outside, the front door of our development, which will, be 30 days. We'll see our first phase of apartments, our first office building, and our first phase of for sale property coming out of the ground. What I like most about this project, and if you get back to looking at Columbus as a whole and the opportunity we have as a city, we're already known as a great sports town. I think we've gained a great reputation as being a good foodie town as well. A lot of people during, I think, this pandemic are maybe reacquainting themselves with their connection with nature. When you can't find yourself in restaurants and you can't always find yourself in movie theaters or, doing what would have been typically your norms. I know, at least in the majority of people I know in my world, are really spending a lot of time with their families and friends out in parks and taking walks and on bikes. And I think everybody probably if you tried to buy a bike this summer, you probably couldn't find it in Columbus because everything was sold out. Our opportunity in Columbus right now to continue to push our integration with, projects that really integrate into the urban core as well into the other green spaces we have in this city. It's a tremendous way for us to distinguish ourselves as a city. And honestly, I think it's exactly offering up what people are looking for today. So that's probably the project we're most excited about bringing on this year.
Well, I happen to live very close to there, so I'm very excited about it personally, especially the parks part. But I think what our audience needs to hear is, how did the lending change since COVID? Did they require more money down? You said you put it on pause. So can you walk us through that part of it without giving away anything confidentially, of course?
Yeah. So I mean, I'm gonna knock on my wooden table here. Post-COVID, or I'm not sure to say, we're obviously not post-COVID. We're smack dab in the middle of it still. We haven't seen our terms change a whole lot. Our equity requirements are still pretty much holding. Loan to debt, loan to cost is staying pretty static. The biggest challenge that we experienced was simply that banks shut down their loan committees, and they were all in a wait and see moment. I don't think it may shift the type of requirements we have to fulfill, get these debts moving, the debt structures moving forward. I'm very optimistic that because our projects are strong, we've always done a great job at making sure we have the right cash in the deal, that I'm not expecting to shift too much in the terms. And now that I think that people, even though we're, experiencing a pseudo spike around the entire country, I think people are getting more and more comfortable that we're going to get through this, and that we're going to get through it as a country in a pretty decent manner. And we need to do it. I think the other thing too is, I think, much like anybody else, bankers are in the same position we're in, is that that's their job. They need to push capital. And I think everybody's in a position now where, in a market like Columbus, where we see a lot of still huge promise and potential, and in the right asset classes, I think banks are very willing to move forward with the right partners, and under still very reasonable terms.
That's wonderful. Before we move on to the rest of our guys, what's going on here local, I want to shift back to Alfredo for a minute and see what your take is on the financing aspect of it, the capital involved on the national projects, and maybe we can compare that to Central Ohio.
Well, and, not too different from what Kevin kind of alluded to already. Pre-COVID, the capital markets were very efficient, working very efficiently, and yet still being very conservative. We hadn't fallen into some of the traps we did in the late 90s, early 2000s, leading up to our financial crisis. So the financial institutions were holding the line and being conservative on their investing, but investing at good terms. When the pandemic rolled out in the second quarter, you saw a lot of banks back down, primarily because, as Kevin alluded to, their employees weren't in the office. Their committees weren't meeting, the boards weren't meeting, and if they were lending money, they were lending them to existing clients and folks that they had longstanding histories with, that they're comfortable with, primarily because there was so much uncertainty and they weren't sure where they should be lending, what kind of credit risk they need to be looking at, what does the credit card look like for the banks? Are people going to start defaulting on credit cards? And then that impacts some of these commercial loans. So there's just so many uncertainties that aren't there anymore, and they're back in the markets. The insurance companies are back in the market. A lot of those guys backed out because they were dealing with forbearance and all that kind of stuff on their retail space, in the restaurant industries, that were asking for it because they had to. And so, it's back to normal. What I will say that is kind of interesting watching is, especially in industrial, you're starting to see some pretty aggressive cap rates out there again, as things are trading. And so the thing you got to watch out for is not the loan to values anymore, it's the debt coverages, because especially if you got a 25-year amortization, those coverages with these skinnied up cap rates and yields that you're seeing deals being done at, sometimes the coverages aren't there to get you that 65% loan. You may need to back down to 60 or 55 or some other number in order to make your debt coverages ratios work better. So there's a lot, you got to start looking at more of the big picture and not just saying, if it's 60%, it always works. It no longer may work, because of some of these interesting things, just as pricing gets more competitive on the industrial side. I mean, I'm sure it's the case in some of the other products.
Wonderful. Okay, Alec Miller, let's shift over to you. I know you're doing some exciting things in mixed use and apartments and urban redevelopment. kind of give us the overview of that and where you see things are now and where do you see them going?
Yeah, sure. So we have quite a bit going on right now, very active in Columbus as well as Cincinnati and Pittsburgh are kind of our focuses for 2020 and 2021. And, we're seeing, kind of to piggyback off of what Kevin was saying, on the front end of the development pipeline, things are full steam ahead, getting things off the starting block, with financing and actually getting things to move forward. For the past couple of months, certainly felt a little bit like running in mud. Over the past, really, I would say over the past three weeks or so, it feels like there's a little bit of momentum coming back, and kind of a lot of the backlogged work is starting to come to fruition. So we're just now we've kicked off a couple of projects, smaller projects in Columbus that we're very excited about. We just announced a third tower that we're going to be doing downtown as well. So everything that we're doing is based around a Class A multifamily component, and then we kind of bring the mixed usage to support it. And in all the markets that we're active in, Cincy, Pittsburgh, Columbus, they have a lot of the same driving factors that we were talking about at the beginning, in which we think that moving forward post COVID, those markets are actually going to be even stronger than they were pre-COVID. And I think it took a little bit of time for the lending institutions to get comfortable with kind of everything that was going on. But now that the dust has settled, we certainly see that there's an appetite to push these projects forward on their end as well.
Wonderful. How about pre-leasing and rental rates? Can you address those two things?
As far as just demand and where things are, you're asking?
Yes. Are you seeing pre-leasing for your projects, and how do you think rental rates are affected since the COVID hit on your existing ones as well as the ones you're bringing online?
So pre-leasing, we don't have anything currently that is kind of being released. We're pretty early on the construction side of things right now. But I can tell you from a rental rate standpoint, where we're underwriting things is we're just being a little bit more conservative. We're not making the same rent growth assumptions that we were going, pre-COVID. I certainly, and I don't have a crystal ball, but due to a lot of the factors that we've already discussed, the demand for markets like Columbus, I certainly don't see rental rates backtracking. How quickly those those rent rates are going to increase, I think is yet to be seen. But frankly, with the amount of new tenants coming, especially to the CBD, and interesting fact that just it keeps popping up, and I keep seeing it, is 50% of the tenants moving to the CBD right now are people who have never lived in Columbus, Ohio before, right? Once again, they're people from New York, LA, Chicago, wherever, and they're used to paying a much higher cost of living. And there's certainly certain expectations around those price points, right? They're used to higher amenitized buildings, just more walkability in the surrounding area. And so once again, we have to be willing to develop the infrastructure to support the product that they're looking for. But to the extent that we're going to be able to do that, I think we'll continue to be able to drive rent prices.
Okay, so that answered part of my question. We did get a question from the audience I want to ask first, and I'm going to shift back to that. What has been the biggest challenge getting multifamily projects to pencil in Columbus? So is it finding the ground? Is it getting the lending? What is the biggest challenge to that right now? That was from Joseph Hirsch.
The two things and I don't even know if this is time specific. I think it's just kind of always the way it is obviously you got to buy the land, right? And then construction costs. Certainly, pre-COVID, we saw construction costs just getting absolutely outrageous. And frankly, it was difficult to make a lot of things pencil. And the reason why we became so active in Cincy and Pittsburgh and some of these other markets was just because we saw more attractive value in those markets. So buying the land right, and then the construction cost is a huge factor right now. And one of the things that I certainly foresee, just as as the demand comes down, for these contractors, I certainly hope to see that pricing adjust a little bit, and we get back to a point where construction starts to make a little bit more sense.
So are you saying, does construction cost vary greatly between Columbus, Cincy, and Pittsburgh?
The construction cost doesn't necessarily vary that much. The acquisition cost, the land cost, what we seem to be able to get our hands on in markets like Cincy and Pittsburgh, for let's just call it a half-acre site, in the Strip District in Pittsburgh, we might be able to get something for $1 to $2 million. You're talking about a $4+ million site here in the short north, right? So just understanding the actual land basis and the value at which we're able to get a big piece of the puzzle at, that's kind of what drove us to those other markets. So with the construction prices being relatively the same. Now, our hope is that as things kind of come out of COVID, that the construction prices are going to move south, and I think that'll happen across the board in all of those markets. But it was really the land costs that was driving us to those other markets.
Okay, I want to shift back to another thing here, because you answered part of it before about how hot the apartment market is and rates are staying hot, especially downtown you were talking about. What about retail rents and office rents? Now, I'm a tenant rep broker that mainly does office, so I'm interested to hear our other panelists' viewpoints on that and what you're seeing happen, post-COVID, and where do you see it happen going forward?
Yeah, so once again, I don't have any sort of a crystal ball, but I certainly think that retail and office are both going to struggle for in the coming years. Particular that the Class B and the Class C type product, there's always a little bit of protection when you're talking about Class A, but there's just, once again, general market economics with as demand drives down, prices drive down, and you talk about something like the restaurant industry, and we're seeing conservative estimates that between 25 and 40% of the existing operators just simply aren't going to make it out of this, right? Well, that's a lot of holes you got to fill, and in order to fill those holes, prices are going to have to come down. And I do think that, and once again, I don't have a crystal ball, but I wouldn't be surprised if there's a bit of an echo effect, whether that's 6 months, 12 months, 24 months down the road, where as these, some of these lease renewals and leases get put in place, and we kind of see the market adjust to the lack of demand, that we're going to see prices across the board adjust downward.
Well, I would agree. I've been on a lot of different panels over the last 3 months, and we think there's going to be a tremendous amount of sublease space for both retail and office. And I think companies are still trying to get their strategic plans together on, retail. How do you keep your head above water, especially if you're a restaurant like you discussed? But for office, how many people are going to continue to work from home? How many are going to downsize their office, maybe permanently, and have some people work from home? How many are going to upsize, expand their offices to deal with an ongoing virus thing? So I think a lot of that's being worked out now. I thought my phone would be ringing off the hook, and a lot of people are still in that wait to see, let's try to put it together mode. So I'm going to agree with you. Nobody's got a clear crystal ball. I think there will be tremendous opportunities out there for both retail and office tenants that do have a strategic plan in place. And with some of the prior two panels being mostly mixed use, there's going to be a lot of professionalism needed and a lot of very tough decisions needed here in the next 6 to 12 months. Alec Miller, let's go over to you in Pizzuti and tell us what's going on in your world.
Well, I think it's interesting to talk about, rental trends, in the industrial side, construction costs, development costs. We're seeing all of those rise. The interesting thing here in Columbus is that we've had historically on the industrial side, a flat rent rate environment for the last almost 30, 35 years, 40 years. There's been some interplay there, which is the availability of land, as well as tax abatements, the cost of the cost of your operating expenses that are built into your gross rents, has had an effect of keeping prices down across the board. What's going to be interesting to see is, as far as Class A on the development side, but also seeing all the way down to Class B, is that we've seen an institutionalization of ownership in the industrial assets over the last 10 years. There's nothing that you could call a Class A asset left in Columbus that has not changed hands post-recession. And what that means is that all those existing buildings, the second generation buildings, are now at an increased basis, which is more or less on a par, at least to some extent, with new products. So what we're seeing now is rental rates have increased, and they're not going back down. We're seeing new developments are having asking rates in the upper 4s to 5s. Whereas we'd seen rents on a net basis be, $275 to $350 from 1995 to 2008, and I don't see that changing. The upside to that, I think, or at least the opportunity there, is that as your overall costs to develop are increasing, that means your individual costs matter a little bit less. In the grand scheme of things, a dollar in TI in a $65 building is not the same as a dollar in TI in a $32 building. For instance, it'll be interesting to see. I think from an e-commerce standpoint, a bulk distribution standpoint, those are all going to be Class A buildings. They're now 1 million square feet, 800,000 square feet. We're seeing buildings come in to 3-foot clear. Truck courts have gotten more expansive. The absorption of land that goes under that building is much more difficult. And so I think, again, what ends up happening or being the real challenge from an industrial standpoint is your land purchase, is not just the cost of your land, but now you've got to build a road to it. You've got to extend sanitary and water to it. You've got to negotiate a new incentive package, whereas previously, when you bought the land, all that stuff was sort of baked in off the shelf. So in that bulk e-commerce scenario, I think we're just going to keep seeing new development rule the day. Rental rates continue to rise with development costs, although, again, we're kind of hoping that, in 2021, we may see a little bit of a track back in those hard costs with more competitive contractors and subcontractors. What'll be interesting to me to see is if there is an echo effect in smaller buildings, older buildings, where smaller operators may not have the financial wherewithal to maintain their operations in place, and we may see some sublease space, some shadow space coming back into the market in the center city.
Wonderful. So for projects, let's say you found a new project today. You mentioned a lot of things you got to do now that you used to have to do. How long can you get something to market from the time you get it to the time you put it in contract and go through all those steps that you were just talking about? Are we talking about 18 months?
It depends on what you buy. There's probably a site out there that you could deliver in 18 months. You're probably paying a lot more money for that. Someone else is doing the work, or will recognize the market value in that. If you've got to go in and deal with the entitlements, and specifically, annexation, utilities, and tax incentives, that's legitimately 24, 36 months, depending on where you're at with the jurisdiction and how savvy the people you're dealing with are. How much of an educational process you've got to go through for it.
It's amazing. I think most people, the public, don't have any idea that you're talking about that long and how much risk and how much costs are going. And that's obviously why developers take that risk to make those dollars, but behind the scenes. So it sounds like from everybody, we've got about 10 minutes left, that it's full bore ahead. We still have a lot of unknowns, but it's really full bore ahead. So another question that came up is, what do we think the biggest fundamentals are now forward site selection. What's really important for our experts here of going in, of how you're picking a site to develop, whether it's downtown, whether it's short north, or whether it's an industrial site in the suburbs someplace. What's really driving that for you? Alfredo, do you want to chip in on this one? Because I know, again, you're doing it on a national level.
Yeah, I mean, if I look at Alex and Pizzuti, I mean, they're doing development, so they're going to be on the forefront of that more than we are. We get the benefit of looking at parks and where not only Pizzuti's at, but where some of the other developers are already in their first industrial, Panettone, Hillwood, there's a whole list of them. And so you can kind of say, okay, that's a good park. That's where the users want to be. So, my selection of the sites is probably a little bit easier than what they're doing. They're crystal balling 12 months ahead. Mine already exists. That is where the demand is. That being said, I do think that in industrial, you are going to see a growth in bulk distribution just because e-commerce in the 3PL market was growing and is growing at a much bigger number now. But I do think we're going to get the benefits of reverse logistics, the fulfillment facilities, and the suppliers that tend to be a little bit smaller users, maybe going into light industrial, in the second generation spaces that Alex referred to earlier, being a benefiter of that type of growth. So it's going to be an interesting model. It'll be interesting not in as much in Columbus, but some of the other markets where I think the tax base from this pandemic has been strained. How they make that up? Do they make it up on the property tax side of it? And that's a big component that artificially compresses the rents, and it trickles down into us. So I don't think it's as much of an issue in Columbus as it might be in Cleveland or some of the other Ohio cities, but it will play into it. And then, lastly, I do think there are going to be some changes inside the industrial box. Robotics is getting to be a bigger issue, and technology is becoming a bigger issue. I do believe you're going to start to see a lot more climate control facilities, which is not for the creature comfort of the workers. It's because the machinery and the technology in there is going to need the dehumidification to protect the equipment and a certain temperature control. So you probably are going to see a little bit more of that in not only the new products, maybe some of the older products.
Interesting. Anyone else want to jump in on that question?
Well, I mean, I
Sure.
think for us, in terms of how do we pick a site? It's just how can I fit my building on it? There are fewer and farther between sites nowadays where you can fit 1 million square feet. And then your secondary question is where are the utilities and where's my highway? Those are the three big issues. But Alfredo touched on it a little bit with with property taxes and what may be coming down the pike. Kind of on these follow-on effects from COVID, is that one impact that we've seen in Central Ohio that's of the tax abatement processes that and availability of those tax abatements over the last 30, 40 years is that there hasn't been the same kind of focus on the actual sticker price rate of taxation. And if you look at where that's going, is once those abatements have burned off, it's a very, very high percentage of your gross operating costs right now. To see, a fully assessed industrial building in Central Ohio has now got taxes of, $1 a square foot to $1.25 a square foot. Whereas 15 years ago, those numbers would have been 50 to 60 cents a square foot, driven by value. And the fact that those, the outside capitals come in and driven up value, driven up rents, as well. So it'll be interesting to see how that, interacts with on a continuing demand and whether we can remain a competitive market versus our competitors in the Sun Belt and Indianapolis, Ohio, and Cincinnati, East Central Pennsylvania.
Wonderful. Alec Miller, you got anything to add there?
Yeah, so I mean, for us, we try to keep it pretty simple. Being, Class A multifamily focused, the first thing and really our main concern is the location. So if it's not a 90 or higher on a scale of 0 to 100 from a location standpoint, we're not even interested. And then outside of that is once you got a great location, to what I was saying earlier, you got to make sure you're buying it right. So if we can pick A locations and we can buy them right, the rest should fall into place.
Wonderful. Kevin?
Yeah, I mean, I definitely agree with Alec. I mean, it's such an age-old adage, but location, location, location. And if people in the audience are wondering, like, what is the right location for a mixed-use developer? And, and much like Alec, too, we're, focused heavily on residential. The simple part of it is its connectivity. It's a very simple concept to understand, very challenging to execute. And so whether it is urban or even suburban urban, the one thing that I'm feeling more and more absolutely certain coming out of this pandemic is that where people keep wanting to describe this new norm, which I think is not so accurate, that people are going to shift away from wanting to be social, or that they're going to always want to work from home. I'm not sure who those people in the news may be talking to, but I know of my colleagues and the people that I'm regularly working with, people are dying to get back to their trends of being professional and colleagues and in an office. And they're maybe in many cases reassessing something they thought was a 10-year goal where they were going to sell out and the empty nester in the suburbs were going to move and push into the downtown. We're seeing it happening now. A lot of the traction I think we're getting is that people are wanting that day-to-day connection is just basic humans. We want it. We're built that way. We're not, I'm not saying everybody's that way, but the majority, I think, of the population wants to be integrated with their lifestyle. They want to be around their restaurants, their schools, their parks. They want to be around their friends. You always can talk about those locations, and they're really easy to understand and what you're looking for, but they're extremely challenging to find.
Well, I'd agree with that wholeheartedly. I've been here half my life, and there's almost no direction that you can point in Columbus that hasn't grown and changed for the better. You mentioned the metro parks earlier. I'm a big outdoor person, and I'm just, blown away on how great it is. I could live anywhere in the world. I chose to move here, and it's been the best thing that ever happened for me and for my business and my family. So I think we have a lot of positive things. We've had a very brief time to go over this, but it sounds like a lot's going on. We don't feel like the banks are going to hurt us too much, that rents aren't going to be too much changed with the exception of maybe office and retail, which there's still a lot of unclarity about that. We do feel like more companies are going to come in from out of town, as well as people from out of town that will leave a lot of larger cities in Columbus because our cost of living compared to those is a lot less. And I've heard that on many of the other calls, that I've been on. San Francisco, for example, of huge tech cities where the costs are just 3 times, 4 times what they are here in Columbus. So I think we'll see a lot of these people look at Ohio, in Central Ohio specifically. We don't have any other questions, but I'm going to say, trying to wrap this up for everybody, I see a lot of bullish times ahead. I think we're going to really have to work together, be better listeners. And as a lot of our panel said, to get together, whether it's on a Zoom call or hopefully soon in the future, together and make Columbus even greater than it is. I want to thank everybody, the panel especially, for some great insight today. And we'll look forward to doing this again next year. So everybody, God bless and have a wonderful weekend.
Thank you.
Right on, for sure.
Thanks,
Thank
everyone.
everybody. Love this panel. Great job. Everybody that's online, I want to just real quick see these sponsors up here. Say thank you to those folks, because without them, we wouldn't be able to do the webinars and the live events that are going to happen soon. I'm at a live event in Minneapolis right now. There's 75 people in a room, and an event we normally get 250 at. So it's coming back, but hang tight, everybody. We'll get back to normal. I've been watching that vaccine tracker every day. There's 8 in there right now in phase 3. So go vaccines. Even if you don't like vaccines, just get back to normal. Somebody just have one. All right. Thanks, everyone. Have a wonderful afternoon. Look forward to doing this again soon.
Thank you.